everybody? We are back. Welcome to a bonus episode of More Than a Title. I'm your host, JarrettThomas, as usual, and we've got a special episode lined up for you guys today. So I've got actually, for the first time, I have a special co-host. He's my best friend, business partner, Tyrone Williams. What's going on, Tyrone?
What's up, everybody?
Thanks for coming on, bro. It means a lot. First episode with you, man. It's a special one.
My pleasure, brother.
Yes, sir. Yes, sir. And we also have a special guest. So I got to give you the good intro. I got to give you the great lined up intro, guys. So you guys read the description, right? Today we're going to talk about the market, but this gentleman here has over 25 years in the space. He has, done everything from treasury management, risk management, portfolio management, you name it. And I actually came across this gentleman through my endeavors in the market, right? So everybody I would listen to, everybody I would watch, everybody I would learn and disseminate information from always mentioned Peter. And then just out of nowhere, my best friend actually, sent me Peter's information. It was like, man, you got to get him on the show. How could you not have Peter on your show? And this is where we are today. So this is a special episode. I want to introduce our special guest, Peter Hahn. How are you, man?
I'm doing great. And thanks again for the invite. This is my first podcast. So appreciate the interest, and let's go and see what we can bring up.
I love it, man. So this is all about you. We're going to talk about your journey. For all those first-time listeners, More Than a Title, as you know, is a show that's geared to really about the lessons about someone's professional journey, right? What they've done, whether it's your CEO, whether you're account executive, whether you have to bootstrap and sleep in your car for 6 months to get the business going. I feel like those are the lessons that are most valuable versus the tips and tactics. And this is what we wanted to present to you guys. But for today, we're going to talk about, obviously Peter's professional journey, but also the market, right? The market is going haywire right now. It's a lot of things that we should know. And there's a lot of areas for you guys to win and make some money. So anything to help you win, that's what we're here for. So if you want to, Peter, let's start at the top, man. Let's talk about your professional background and kind of what led you into your industry and your career.
Sure. Okay. So just to summarize before we get into it. I have worked in the financial market since 1995, right out of grad school. I started at the Bank of Canada. I did variety of roles there, but I was on the foreign exchange desk back when the central bank still intervened in the market. And then I joined their reserves management desk, which is basically managing their foreign reserves. So some really good experiences there. The idea with working at a central bank is they don't pay very well. They pay better now than they do, but they didn't pay very well. And so you basically spend a few years there and you'd use it as a working experience, like a elite finishing school, as it were. Yeah. And then you go out in the private industry. So I pretty much did that. After I was at the Bank of Canada, I joined TD in Toronto on their FX desk for about 2 years. Transitioned back I basically went to the Bank of Canada, TD, back to the Bank of Canada. And then from there, I was, realizing again, it's like I've been at the bank for 8 years now. Even I got more experience. It's more valuable. The civil service salary can only go so far. You want to do something with your life or you want to have a safe job. And my view was I learned a lot in the central bank role, but there was a lot of opportunity out there. For family reasons, I wound up taking a job in Alberta. I grew up in Alberta. My family was all in Western Canada, and I had been out east for 10 years odd. So I wound up taking a job with ATB Financial, which is it's a crown corporation owned by the Alberta government, but it provides the same banking service as all the Canadian banks. Yeah. And from there, I basically ran their FX desk, which was kind of an interesting time. And since then, I've been basically bouncing around a few roles. I wound up working at Scotia on their deposit specialist role, basically advising companies on what to do with their money. And then since then, I went to a sort of portfolio management role, which I've been currently in for a few years. In terms of the education to get there, then that was the interesting thing. What got me into markets in the first place? We have to go way back to 1987. I was still in high school. Mm-hmm. My dad worked for the Canadian government as a diplomat, so we were posted in Sydney, Australia. So I was living in Australia at the time, and the big topic there was the Australian dollar used to be fixed, and they decided while I was in high school to float it, so it basically would trade with the market. At the same time, the movie Wall Street came out. Michael Douglas, of course. Yeah. And I thought, holy crap, this is exciting. So I didn't care about stocks at the time, but I did like foreign exchange because, again, I've been covering it in high school all the time. So I thought I want to be a foreign exchange trader when I go to school and get out of school. So how do I do that? Well, in the old days, you really just needed a high school diploma. You could walk into a bank and say, hey, I was the head quarterback for this team. I am really aggressive. And we like that idea. We want you to be really aggressive. So to be a trader, you got to be like, take no prisoners. And so that was the idea. But then things sort of got elevated. Computers came in. It's like, well, we need someone with a little more education for these roles. And so they said, okay, we need someone with a business degree. And then it was like, okay, well, now everyone's got business degree. We want to winnow out the applicants. So we want someone with an MBA. So you wind up getting this what they call a funneling effect, where you got to have more and more gradations to get to a job that didn't need them before. But in fact, the market did get more complex. Computer trading programs came in. You did have to have some idea. Clients wanted some kind of wanted to see that you had some kind of education. So absolutely. I wound up being lucky enough that I had really good grades in high school. I was able to get into Queen's Commerce, which was considered one of the best business schools in Canada. A little overrated, because when I graduated in 1992, is like, I'm way back now, you guys. This is like, yeah, I'm old. But,
all good.
There was a recession caused by, if you remember, well, you won't remember, but there was an election between George Bush and Bill Clinton, and the whole thing was the thing Bill Clinton was saying, it's the economy, stupid. And it was, because during the early 90s, we had a real recession, not as bad as 2008, but it was a bad recession. Mm-hmm. And so you had really no choice as to your ideal career. Like in my business school, even though it was the elite business school, not a lot of good job offers. So I wound up working in Whistler, of all places, as a waiter in Chateau Whistler, which is the big ski resort hotel. And then I realized I really don't want to do this for the rest of my life. So I got to go do something about that. And I went to grad school. I went to UBC, which is, again, a big school in Canada, one of the best business schools in Canada. And I wound up doing a master's of science in business administration. I didn't want to do an MBA, because an MBA is basically just basic courses, and I'd already done that. So doing a master's of science, I was able to pick and choose more directed courses, because you want to basically show value added when you're talking to recruiters. And then the nice thing about UBC is they also had an internship program, whereas Queen's did not. So during the summer, I was able to get a job with the Bank of Canada. And so that sort of gave me an in when I finally graduated. It's like, well, I did get interest from a lot of different places, but like the Bank of Canada was the easiest one. And it's like my plot, even then, was like 2 or 3 years finishing school, then go to Bay Street or Wall Street. So it was all sort of contrived, and like I got this all planned out, because I didn't want to spend another 2 years in grad school and have exactly what happened to me in my undergrad, which is basically assuming I'd have multiple job offers, but nothing happened because of the economy. So you got to basically be aware. I'll give you a context here. When I graduated in 92, there were no offers. If you had waited 5 years when the tech boom started to happen, you were getting 2 or 3 offers out the door. So it's not necessarily how good you are, it's how lucky you are. And that's one thing a lot of people don't appreciate is demographics. And the other thing was going on was people were saying, I don't want to work for Wall Street. I want to go work in Silicon Valley. So it really depends on the trends going on and what you want to do. And then you got to cater your education. Like, if they're going to still, select only a certain pool of people, and they have to go to certain schools, or they have to know somebody. That's the other thing. And the unwritten rule is like, who do you know? That cropped up a lot. It's not supposed to crop up, but it crops up. So it's like, I went to school with so-and-so, and he works for you there. We'll tell him and see what he thinks about you. So that's an unwritten rule. But it wound up helping me, because Queen's and UBC were 2 of the schools that the Bank of Canada heavily recruited from. So I got to work at the Bank of Canada, and I started off in the bond auction desk, which was basically just running the debt auctions every week. But that was kind of not what I wanted to do. And then a role came up in their foreign exchange desk, and I just went for it. I said, this is what I want to do since high school. And I made a very aggressive push, and I knew all my stuff. And so I beat out a whole bunch of other people who'd been there a lot longer. And I got on that desk, and it was the job I was born for, man. It was awesome. You basically, at the time, again, Canada had a floating exchange rate, but they went in every day and tried to manage it. So it's called a dirty float as opposed to a freely float. And the idea was we want to, I'll get into it later, but they wanted to basically manage the volatility of the exchange rate. It's like, if it moves too much, we don't like that. And that was sort of the idea, is you come in and you go buy, sell Canadian dollars versus US if the exchange rate moved too far. And while I was there, we wound up going into the Asian currency crisis. And so for a long time, I could go on for hours about some of the stuff that I saw, but the main fact is I got a lot of experience trading large amounts of money and talking to the head traders in Toronto. So that was a really good background, and that basically facilitated one of those people in Toronto calling me and saying, "Hey, I got a role here. Would you like to join us?" So I joined TD, and the funny thing about investment banks is, like everything. Oh, it's a team game. No, no, no. Like everyone says, oh, those banks are out to get us. What they don't realize is every little portion of a bank is a different empire. It's run by one or two guys, but everyone else is like fighting amongst themselves for resources. So I would see it even on my desk where my boss was like taking advantage of the forward desk, and they eventually found out and were furious, and they basically totally bring back all the money that she'd been stealing from them. So, there's these empires within empires in the banks, and so not everyone's on the same team. So somebody may be shorting AMC and someone else may be long AMC, but you only hear about the shorters and you don't know what else is going on there. And that's like, so like, example, people say, oh, RBC, I'm concerned because I've got funds with RBC, but I see that their hedge fund is long AMC puts, they screwing me. It's like, it may or may not be the case. You don't know the full story because you don't get all the information. So that was the most interesting thing about working for TD was it just it exposed another example was there was a guy at Bank of Montreal who was running an equity fund. He would go prices for his foreign exchange trades with his foreign exchange desk, and they would overcharge him. So he had a friend who was my boss, and they would wind up calling us to do their foreign exchange. Like he's calling a competing bank to do his foreign exchange because we're giving a better rate than his own bank. So that's just how warped Wall Street can get. And so you got to put all that this stuff in context to understand some of the stuff that goes on with the equities is so convoluted that we can't even begin to imagine what kind of backroom deals are going on. Because I said I was shocked that I was able to do trades with a competitor because he'd rather do with me than his own trader because he hated the guy. So it's just interesting.
That's insane. First of all, I love the context, and thank you, like for explaining your journey, man. So, and I love the market because of the complexities of the market, like you mentioned, right? And me and you have a very similar story in terms of how we got into the industry. I actually was a waiter too, so that was actually really funny. So I wanted to say that, and I snuck in the door. But so when it comes to where you are now, right? Like I said, I would love to start with where you just mentioned. So, as far as AMC, I got into the market. I saw the dip. I saw everything that happened when it exploded. I was on the tail end of it. I missed the money train. I was pissed off, and I'm like, man, let me go in and let me figure out this thing, right? The biggest problem for most traders, from what I hear, is the same problem I had, right? So I go on YouTube, I listen to Keenan, I listen to Trades. There's a YouTuber that pops up every 10 seconds on there that's talking and giving financial advice. So what advice would you give to somebody like myself or somebody else in the audience to handle, how do we understand what's real and what's not, and the misinformation that's out there?
Yeah, that's a really, so I have to give some more background just to give some. So my background trading professionally was foreign exchange and bonds. So I didn't do a lot of equity trades at all. In my personal life, I kept my funds in fund of funds, and I would basically just try and time major events like elections. And I was making okay returns, but nothing substantial, like 6-8%. It's retirement fund. I'm not going to worry about it. I was as a stupid trader, I'd always have a large income. So I spent a lot of money over my life and had a good time, but I didn't really have, aside from my pension investments, I didn't have a lot of investments. I had toys and I had, a condo and an apartment and all that, but I wasn't playing around. And then I saw my bosses saying, I just made 30% on ARC this quarter. I'm going, what the hell? Yeah, like that was like Kathy's big move, right? So I said, okay, I got to start paying more attention to this. And I started moving I created an interactive brokers account. So I'm going to do day trading here. And of course, what happened was this is on the same time that GameStop blew up. And I saw it go from 40 to 72. And I made a post on LinkedIn saying, this is ridiculous. I know gaming. I've been gaming my entire career. I don't buy my games at GameStop. I go on stream and buy it. Why would anyone go to GameStop? And I made a post about that. And oh my God, like when I make a totally correct call about what the bank account or Fed's going to do, I get like 2,000 views and 100 likes and 50 comments at most. When this GameStop post, I got 100,000 views. I got like 300 comments. I don't remember the likes, but it was ridiculous. And so a lot of them were like the traditional people that say, oh yeah, Pete, yeah, tell them this is totally bogus. And then I get the GME guys that are saying, you're a stuffed shirt. You have no idea what's going on. Ryan Cohen's good. And I go, oh, okay, well, yeah, but then the next week it went back to 40. And I said, case closed. This thing was a flash in the pan, but it'd gone up to 500 first, right? So those guys that were commenting, it's like, you don't know nothing. It's going to go 400 tomorrow. And it did go to 400 tomorrow. So I like going, okay, well, they were right. There was some kind of weird squeeze going on, but it's done. And the fundamentals are reasserting themselves. But then I sort of let it go. And then 3 weeks later, it's like, oh, defucking value, excuse the language, he doubled his position. And it's like, what is this guy doing? Like, why wouldn't he just taken his money and got out? Like, what was he doing? And then GameStop blew up again. And it's like, okay, there's something deeper going on here that I need to be aware of. Because until that point, I've been like every other guy on the street. It's like, yeah, these guys are just fools. They're wasting their money. They don't know what they're doing. And so then I took a deeper dive, and I wound up looking at GameStop and in AMC, and I said, you know what? There's a lot of stocks here that seem to be in this pattern. Like, again, all the ones that ripped in January and then came down. Well, I don't want to do GameStop because it's $250, but AMC is like $8. So I can play around with this. And I started day trading AMC. And then as a trader, I recognized, this is very atypical behavior. This doesn't make a lot of sense. And so I started looking at it even more closely. And the day that convinced me that there was absolute manipulation going on and this was a play was the day that GME fell from 250 to like 125 and AMC dropped from 14 to 10 or something. And it's like, okay, this is BS beyond belief. And they wouldn't be doing this unless there was a serious underlying issue here. This is too ridiculous manipulation to get away with. So I went all in, and I was like scouring Reddit. I was scouring, Twitter, not so much. It was mostly Reddit at the time. And I was picking up some YouTubers, and I was doing what you do. I'd be watching Trey's and Matt Kors and all these guys. And I was, these guys are all young. They really don't know what they're talking about, but they must know what they're talking about on this play because they've been following it longer than I have. So then I started to realize as time went on, there was a difference in quality between some of them. Yeah. And of course, then there was the infamous bald guy from New York. And I won't name his name. But, it's like this guy seemed to be saying some stuff that sounded like he either had a contact or, had some real experience. But then he'd be acting all crazy. So it's like, is he doing this to be vague? Like what? Anyway, I started picking up on some of the stuff, and some of the stuff said, yeah, this would be explaining how they're able to do this and the delaying orders. That sounds like that's nothing you don't see that in FX, but okay, in equities with the delay, the 3+3, and like if a market maker is controlling the flow, I hadn't been experiencing that. And my knowledge of the DTC at the time was basically like, yeah, the idiots that settle all my bond trades. I don't really care about them. But now It's like, I got to take a deeper look into what these guys are doing because they're facilitating naked trading. And I've never encountered that in FX before. You do a trade with a guy, it settles or else, right? So I'm not familiar with this non-settling stuff. So it was an education for me. So like, don't feel bad that you like got to listen to these YouTubers and all of a sudden you're feeling like you're being the rug pulled under you because really no one had a real clue what was really going on. And I think it's been an education for all of us. Yeah. So the only thing I could say is for people that have been in this play for a while, you have gotten an education that you would not get through a CFA. You would not get through business school. They don't teach any of this stuff in business school. What has happened in this market has evolved dramatically in the last 20 years because of IT and tech. The ability of what they can do electronically is high-speed trading. It's all a new game. And they've basically been full out displaying all the ways they can manipulate things. And none of this was to be known from day one. And so to be fair for the YouTubers, a lot of them were just learning on the curve as well. Some of them are really irresponsible in what they presented though. So that's what I say. Like the main thing is you got to do what you were doing and not just view one guy and say, oh, I like this guy, I trust him. You gotta watch a lot of guys, even guys you think are really boring, and it's like, oh my god, this is like watching. Because there are like I was watching some of the silver and gold guys, and some of them are really painful to watch. It's like,
oh my god, tell me about it.
I'm Justin Maka 1, 2, 3. Today we're going to talk about oh my god, but maybe he might say something interesting. So you got to suffer through that.
So true.
If you do enough of it long, you get to know the good and bad for all those guys, and some of them, as I said, I stopped watching like Matt Kors fairly quickly. Trey I would watch when I could get the time, but most of his were live streams that would go 6 hours, and sometimes he'd go to work and leave his stream on, and people were just chatting about his chair, and then go, "Oh, Subway Cup, Hell Subway Cup." Or, okay, it's funny, but you're not learning anything. So it's a different presentation style. All of them had different presentation style. And then like when I blew up, it was kind of freaky because I'd be seeing it's like some of them going, oh, Wall Street professional exposes corruption. It's like, oh, that's me. Oh my God, I don't work on Wall Street. It's like, so a lot of the YouTubers are like unintentionally funny, but also scary, right? It's like getting into a cab with a cab driver who doesn't really speak English, and 121 West 5, no, 141 5 side, no, you're driving the wrong way. That's what some of these YouTubers like. It's like, oh my God, just like they got like when reverse repo blew up, they were reporting it wrong. It's like, you guys, there's a lot of misinformation out there, and I said the only way to get through it is to just power through hours and hours, and hopefully your gut pitches on to who's talking crap and who actually is guessing and who might know something, and it's hard.
Yeah, that's a great point. And I have the same, I tell everybody, Dior, do your own research, guys. It's good to listen to all the, Matt Kors, trades. Like, I learned a lot from those guys. Keenan, shout out to them. Yeah. But you still have to do your own research. So certain terms I would hear from them. I would go and Google it. I would go look at other sources. Absolutely. I would see who else is in the Reddits, who's saying what in the Discords. And you're really going to have to filter out that information to figure out what's real and what's not. So I know it's a lot of time, but for what the return can be on some of these investments, it's worth it, guys. So I would love to talk about the manipulation and stuff. I was going to say, Tyrone, I would love for you to say to the audience, can you break down what's so special about AMC, GameStop, and the meme stocks? Like, can you just explain that for everybody listening?
Me and Peter.
Either one. You want to do it? Hey,
I'd like to hear your feelings.
Well, to me, AMC is like, well, they call it a meme stock. I don't really like the name. I just think it's something that has a great community behind it. And I think it's just a community with people that came together for the same, purpose. And I think it's bigger because as we can see, is we trying to expose all the corruption. That's what I think. And I think, absolutely, that's really what it is. Meme stock. I mean, AMC and GME is probably just the bigger ones that we know about, but it's a lot of stocks like this that's heavily shorted that we feel like is going to expose a lot of corruption. Yeah. And that's another thing, Peter. Like, do you think we will ever get to that point where all of this corruption would be exposed, or like would it be a shakeup in the way the market is ran?
Was Gary going to do something? Is the SEC?
Well, then, you know what? And this has been an education for me. So I walked into this. I work for a central bank. I have the expectation that government authorities should be doing their job. What's different in the U.S. is that a lot of the Washington roles are politically influenced, and politically influenced means special action committees get donations from private investors. And so there's an agenda that's like clear that there could be, definitely like fun, like you said, people, the SEC's bribed, not directly, but through donations, who knows, right? So expectations for things that happen in Washington that I thought would be like, yeah, there's a systemic risk to the market, what these guys are doing. You're letting them create like huge risk profiles that shouldn't allow to be happen, but nothing would happen. Like I saw the NSCC and the DTCC coming out with all these rules. I said, they're slow on the draw. They're years behind, but they're doing something. And then no margin calls. Yeah. Gary Gensler says, we're against payment for order flow. This is wrong. And it's like nothing. And it's like, Gary Gensler, I've only been in the job 3 weeks. It's like, I've only been in the job 5 months. I've only been in the job 2 years. It's like, when are you going to do something you don't, so I've been very disillusioned by that. And the only thing I can lead it up to is there is a lot of political interference from senators and from, congressmen that basically have been influenced by private sector entities. And especially the payment for order flow issue. It's like there's clear that some politicians have spoken out about banning it, and they're clearly been receiving donations from people they don't want to stop getting donations from. So in that sense, the whole political process and the market are interlinked. And that's been kind of the biggest disappointment for me, is like, it takes a huge thing like 2008 for regulations to change. And I think what we're seeing here is exactly like basically nothing was, there were a whole bunch of, as a technological investments that occurred, and IT's got better, and the DTC doesn't need 3 days to settle equity trades. Everything can settle within T0, to be honest. And yet we still have this antiquated system because it benefits brokers, it benefits market makers to delay orders, and like it's heinous, and it should be stopped, but yet nothing happens. So from that extent, I think the difference now is two things: the size of AMC Bigums is big on reporting the derivative exposure of banks. And if you look at the exposure that they have now compared to what 2008, the amount of derivatives on the books or off the balance sheets are huge compared to 2008. So all they've done is they've taken the problems over 2008, they kicked them down the can, and then they've added to exposure. And they've been able to do so because interest rates have been low and stable for so long. And so what's now happening is the Fed has basically said, well, if we don't hike rates, we are going to lose our entire credibility about inflation, because they should have started hiking rates a year ago, and they didn't want to, because they wanted to try and gaslight people and say, hey, there's no inflation, it's transitory, don't worry about it. But the problem was it wasn't, and inflation expectations took hold, and that's bigger problem. The actual level of rates isn't a huge problem. It's when people expect more and more price increases, and they build it into all their expectations for pricing, and that creates a spiral effect that gets out of control very quickly. What happened in the 70s. So the Fed realized, okay, we're going to lose all control over this unless we actually go on overkill. So they've basically raised rates aggressively. And what this means for the banks is, between all the new margin requirements that have been put in to stop these people from taking these positions, which they already have, such as these huge short positions in AMC and all these other stocks, and now the interest rate hikes are going to make these positions much more expensive to hold. So will there be a squeeze? Are we going to get paid? We're going to get paid somehow. I don't know when, and I don't know how it's going to happen. But like what's happened with the rate hikes and the margin requirements, it's not sustainable for these guys to keep dunking on the things. And to your point, it's not just AMC, it's not GameStop. It's across many stocks, not just meme stocks. And I think, why do they do this? I realize, to me, it's like a poison pill effect. They basically have made it so toxic to unwind these shorts that they have to get a bailout. Otherwise, it would destroy the system.
It kind of sounds like you said. It seems like you're saying, so phase 6, you see it actually working down the line eventually.
Eventually, they cannot. They structure all this on the assumption of low and interest rates for longer. So you can take on a whole bunch of margin. Now it's like JP Morgan a few days ago was complaining about these new margin requirements. It's like, yeah, no kidding. It's like, it's going to cost you money. Well, it should be, because you've been loaning out too much money to people. And it's like the assumption is, there's all these liquidity we can access, and now liquidity is being drained. So now you're going to be more exposed to risks, and you're going to take some losses because some of your clients are not going to be able to pay back their funds. Exactly. And we've seen that in the crypto space. We saw that with the nickel. Like JP Morgan was the hook for like billions of dollars on the nickel exchange until the LME basically changed the rules and canceled trades. And so JP Morgan was able to use that to get out of their position. They saved $2 billion they were going to lose. But like that, again, it's absolute corruption. It's like, I would not trust the LME, and the LME is under a bunch of lawsuits now because people that were in winning trades had their losses, like they had these wins canceled. It's like, do you want to go to a casino when you get a blackjack and they say, you didn't actually get a blackjack? Sorry, we actually won that hand. It's like,
great analogy. Great analogy. I love it. And I want to take a step back and to move forward, because you guys are hitting some great points, right? So for anybody listening, right, for the two stocks, or specifically what got me into AMC and what makes it special is that the public owns a majority of the float. So that's what it is. And what does that mean, guys? That means basically us as the ape community, we own 80% of AMC, right? And what the brokers are doing, they're betting on it to go down, right? Think about the pandemic. Nobody's going into the movie theaters. Nobody's buying popcorn, right? So they're thinking fundamentally about this play when people in the community said, hey, let's all grab this stock and let's hold it. And then with them short selling it or betting on it to lose, as it goes up, they're gonna have to pay and cover those losses, right? So that's where we are right now. We're at a point where the apes are waiting for that day to happen, and we're waiting for the government, the SEC, some of these entities to come jump in and say, hey, you're gonna have to pay out eventually. But like what Peter's saying, when that day comes, it can crash the entire system essentially, because there's so much manipulation going across not just AMC, not just GameStop, but so many others, and we don't know where all this liquidity is going to come from.
Exactly. And I point out the people say, overstock and blah blah blah, all these other times nothing ever happened. It's like AMC is like, if GameStop was public, AMC is way too big now. It can't be ignored.
Exactly.
Like I said, you could basically, in the old days, there was not as much media coverage. You could short a stock to oblivion. You could put Blockbuster into seller boxing. You could basically have these stocks where you shorted it to bankruptcy and you're laughing to the bank. AMC is too public. Like people, like it forget the mass media that miscovers it. It's just, there's too many people that own it. Too many people geographically spread out. It's not a small stock. It's not even a Blockbuster or a Sears. It's too big. If it goes down, if AMC were to be seller box because they like took the price down, it would never. You would have like people storming their congressman's like office, we've been defrauded. So it has to be fixed. And the problem is that they instead of fixing AMC, they decided to spread the problem across the market. So now it's like, now it's a liquidity issue. How is everyone going to pay for all this? And a guy, we was doing a voice call this morning with someone else, and they mentioned This is an analogy to you're owning a house, you're behind on the payments, you keep getting the bank to call you for payments, and you may or may not make them, but eventually they're going to come in and basically toss you out of the house. And that's basically what it comes down here. It's like they're not making their margin, or they're making their margin calls, but they're not closing the positions. So eventually they can't afford to make the margin call anymore. They're going to basically get tossed out of the position, and someone's going to close it for them. And that's basically what we're waiting for. And it may come to the point where the DOJ gets involved, and it's not just closing the positions, it's people getting arrested. And of course, the DOJ has, there's a short selling investigation that's been going on since at least last November. What's new is that the DOJ has actually said last week, for the second time in a year, we're going to start focusing on white collar crime. We're not going to just fine you anymore. We're actually looking for jail sentences because we recognize the incentives right now for actions is too easy on you guys. So, so this is like they said this last November when they started this probe, and then the things have continued to go off track. So they're basically saying this is your second warning, and we're serious. Whether they actually give a third warning or whether they just start arresting people, I don't know. But the other thing they said 2 weeks ago or a week ago was we're looking at short selling of Microsoft and Amazon. So if you're going to open an investigation of short selling on these stocks, but you haven't commented anything on your original investigation, that means you haven't closed the original investigation, because if you found nothing untoward in AMC, you wouldn't be opening a new investigation or expanding it. You would basically only expand if you already found problems in the smaller stocks. So now you're escalating it to the bigger stocks. So this makes me very bullish that at least the DOJ is working on it and they're not stopping us. So
I hope so, man, because I have to see the cuffs. I have to see the cuffs, man.
I know, it's so frustrating. And that's the thing I was saying a few weeks ago. I was getting really irritated by all this. And I said, look, when I got into this, it was for money, and I still want to make some coin. But I put in too much time and investment, and I've been attacked too much that I need to see someone behind bars now. I don't, in 2008, there was one guy that got arrested, and he was a little schmuck anyway. I'm sure this time around, they're going to go for bigger fish. You had Michael Milken arrested back in the 90s, right?
Yep.
So you need to have that kind of level guy. And whether that's, maybe Ken Griffin's got a lot of political protection. In fact, this week was interesting. It's like Ron DeSantis is the Florida governor. He basically is thinking about running for president. And Ken Griffin used the fact that, I would be willing to be Treasury Secretary under DeSantis. So he's obviously thinking he's immune. But, there are other figures in the industry that have got similar targets on their back. So we'll have to see.
Yeah. And also, which brings me to the Robinhood stuff, right?
Yeah.
The Robinhood. So can you explain what happens with that? Obviously, so for those who aren't familiar, you guys saw it in the news, right? So when the stocks jumped up, I think AMC went from from $10, $15 to about maybe $100 or something like that.
72
was the
there's two episodes. So the original episode was GameStop went from $5 to $494. At the same time, AMC went from $5 to $20. And then they both came down. So AMC had its jump in a few months later, and that was mostly an option-driven thing. So there was a company called Mudrick Capital who has basically done stuff with AMC before and done convertible debt issues with them. And critics of Adam Aron say he's got too close a relationship with Mudrick. Anyway, what Mudrick was doing in May, June 2021 was they were selling calls. They were basically selling AMC calls. They thought that because Wanda, who was a Chinese conglomerate, was basically looking to sell a huge portion of their shares, that AMC would not go above 14. So Wanda was basically looking to sell above 14. They were selling at 14. And every time they tried to sell, then people would short it and bring it down. So Mudrick was complacent, thinking, okay, we're going to sell calls on AMC for $35 or whatever, and we're gonna keep doing this. And what happened was Mudrick ran out, and Wanda ran out of shares. They finally got cleaned out because so many people were buying AMC because the retail movement was getting bigger and bigger. Yeah. So Mudrick didn't anticipate the amount of retail people that were piling in to the market, and also they weren't keeping track of how many people were buying AMC calls. So what happened was when Wanda got cleaned out, it jumped from 14 to 38 or something in a night, and all of a sudden, Mudrick was scrambling, and then they did a deal with Adam Aron. It's like, okay, Adam had 30 or 40 million AMC to go. He gave them 20 million shares, and here you go, and they got him at 36. And then stupidly, they sold them at 39, which was like, and they wrote up figures saying, oh, we don't think AMC is viable at these levels. And of course, meanwhile, the people were still piling in and buying more and more AMC call options. So they sold the 20 million that Adam Aaron gave them too quickly. So they made $3 on that trade, $3 on 20 million. But then their call options were underwater, and AMC exploded to 72 because the next day their risk management department said, close your option position. So instead of keeping those AMC shares to hedge against their option short, they just sold the shares and they were short the calls and they got blown up. So that's why AMC went to 72. When Mudrick cleaned out, then AMC had another 20 million shares and basically gave them to Citibank and another bank. And that's when Adam Aaron, basically people accuse Adam Aaron of stopping the squeeze because they all got dumped at 72 and AMC dropped down to 50. Now, the whole issue here is like AMC made a lot of cash doing that, and it helped their balance sheet immeasurably. So instead of having, they had over $1 billion in cash. So you can fault Adam Aaron for stopping the option squeeze, but you can't really fault him for doing what was right for the company. So a lot of people, including some of the YouTubers, blame Adam Aaron for like killing the squeeze. Well, he did kill the gamma squeeze from the options, but it's not clear how much Mudrick would have been caught off guard otherwise, because I said Mudrick could at least been told to cover it that night before. So it's like that process was already in place going forward as that squeeze was happening. So it may not have gone to 100 anyway. We'll never know. If Adam Aaron dropped the 20 million, maybe it would have got to 135. Maybe that would have prompted more, FOMO buying. We'll never know. Now, what happened in January 2021 was not AMC directly related, but what happened was, so Robinhood has basically, as a market maker, was selling people positions, and they were basically then fronting that sale to Citadel. So they were basically paying for order flow. Here, this is our flow from our customer base. We're short how many AMC shares, GameStop shares, and also here's the option positions we're short. And so all the other brokers were doing the same thing. They were basically, here's our flow, Citadel, you go do this. And we get paid for Citadel for giving them the flow. Now, Citadel was saying, okay, we're in an uncomfortable position here because we're now short, and this thing is going up on like option again gamma squeeze on GME. So GME was getting gamma squeezed, and so it was very dangerous because when option positions are large, the leverage on that is 100 times what a share position is. So all of a sudden, the brokers are becoming more and more liable. And what happened was that the DTCC is trying to do their job, and they don't do it very well. But they said, okay, hey, Robinhood, we're just seeing the positions you haven't sold the Citadel yet, and they're huge. It's like, you don't have enough margin here. We need to, we're calling you for $3 billion extra. And like Vlad apparently got this call at like 4 a.m. and said, oh, we don't have that much, but we're going to, but they'd already been looking at this problem already. And they've been discussing with all the other brokers before the DCCs called them. It's like, we're going to switch off the buy button. So we're going to limit the ability for these people to add to our exposure, but we're going to let it sell only so they'll get panicked and they'll sell to us. So we'll cover our short position that way. That way we won't need as much collateral. So when the DTC said, we need $3 billion, it's like, oh, Vlad said, I can't do that. Can we get a wiggle room? And I don't know how or why, but the DTC said, okay, 1.7 billion instead of 3 billion. So they went and did a debt issue. They ran around, they begged people for money, but they also did this close, which they didn't need to do because they'd already got the exemption from the DTC to only do 1.7, and they were able to raise that from funding. So this whole cutting off the option or the buy button was unnecessary. And it wasn't just the Robinhood that did it. No one else was getting collateral calls because most of the other brokers were worried, but they were basically, they had enough margin. So this whole thing is like Vlad saying, oh, we had to do it because the DTC gave us a margin call is incorrect, because they already got the DTC to lower the margin for them. But meanwhile, everyone that was buying GameStop, like, oh my God, I can't buy GameStop. Oh, people are selling now because they can't buy anymore. They know the FOMO's gone. It's like, oh, my option call, I'm trying to sell it at, when I try and sell it, it's like the value is dropping dramatically. I got to get, I'm trying to get on. So what it did is it basically got all the brokers off the hook. And Thomas Pettifree, who is the CEO of Interactive, he's basically been on an interview telling CNBC, it's like, these option positions would have destroyed the market. So that's how bad the exposure was, that they knew that they were okay in like 1 or 2 days, but if it continued, if GameStop had gone to $1,000, they would have probably blown up the market. because of the value of those call options would have just exploded. So the main thing was the thing with GameStop would happen was that people realized that the gamma squeeze was capable of just nuking the shorts. And so at the time, the shorts had never seen that before. They hadn't seen an organized push to buy call options.
Yeah.
Retail had been buying way more call options in the pandemic than they had been previously.
Yeah.
So it had been like the Reddit crowd had sort of educated everyone. And I think there were Wall Street hedge funds that were long GME that were basically educating people in Wall Street bets how to do this. So don't think this was just retail. This was people on Wall Street in hedge funds that were long AMC and GME and meme stock that were telling the retail guys, this is what you need to do. So like,
wow.
In a sense, it's not just us versus them. There were hedge funds on both sides. And there were some hedge funds that got out at $400 because they knew what was going to happen. They had inside information the buy button was going to be taken away. And so they knew to take profit early, whereas the retail had no such information. So the retail got left holding the bag. And the institution hedge funds that were long got out and made a crap load of money. So that's what happened with 2021 January. But it was a contrived plot, and it was basically collusion among the brokers, and it is illegal, and that's why we had the hearings, the congressional hearings, and they should have come out with a more resolute stand, and that's the biggest disappointment. Again, it's like, is Congress capable of smacking these people the way they should have been smacked? Because I won't say for certain if Ken Griffin lied, but I can tell you Robinhood lied, and that's why there are lawsuits against Robinhood for that very reason.
Yeah, and what I aside from the manipulation, what I hated about it is what it did to the trust and credibility of the market to the retail investors who were new like myself.
Exactly.
So that was the more so. It was like, man, I'm right in the market now, but now we're actually winning. So that's like back to your analogy with the blackjack. Now I've got you. I've got 20. I've got 21. I doubled down. I've got my money, and I can't play another hand. I can't do anything else with it, right? Or you're telling me you're going to give me a fraction of what I've won.
Exactly.
And that's really what the real problem is. And then back to your other issue now. So now you bring it up to these congressional people, and then there's political donations, there's alliances, there's allegiances, things that have to, everybody's, I got to keep my role. Right. Yeah. And we're all those things. There's things like dark pools. Right. I would love for you guys to touch on that, too. Right. So I just learned about dark pools. And for those listening, it's basically a closed market for the elite. That's the best way I can put it. Unscripted.
The idea with dark pools is that, okay, we got a fund that wants to do a large trade, but if they do it publicly, people will front run them. So we don't want to be front run by everyone else. So we want to have it privately and discreetly done. It's like all the banks say, we can create these exchanges that are like members only. It's like you have to be accredited to use it, and our biggest clients will qualify, blah blah blah. And so, you can do your big trade here, and we'll find an offsetting trade somehow. And then basically the price impact will be minimized. So you can do your trade discreetly, and it won't influence the market price. And of course, the lawmakers say, oh, that sounds like a great idea. It's like, we don't want big traders manipulating the market by doing big trades. So it's like anything that can mitigate that is probably good. So that sounds great. The problem is that, again, like anything in the market, it gets abused. And what has happened now is, like, instead of just select institutional clients using dark pools, what's happened is all the retail flow, what they call odd lot trades, has been lumped together. And because it's all the order flow is controlled by market makers, in particular Virtue and Citadel, they package these odd lot trades into huge batches and then send them to the dark pool. So you're seeing, like, trading in AMC at one point last year was like 82 or 84% dark pool, and only like 15% is visible, which means on an actual exchange. So when you think about what happens on a lit exchange, every order goes through, and every trade has an impact on the momentum of that price. The computer algorithm at the exchange says, okay, the price is this. Oh, we just had a large trade come through to sell. Okay, the price is going to drop. Oh, we just had a huge order for buy orders. Price is going to go up dramatically. But what happens is, if you route a lot of those orders to the dark pool where they're muted, then you can control, okay, we'll let all the big sell orders go to the lit exchange, but all the big buy orders will get shunted to the dark pool. It doesn't matter if it's a real dark pool participant or not. If it's a large retail whale, okay, he's going to the dark pool. So you could be buying 200,000 AMC shares, and it will go to the dark pool, even if you're a retail investor. And that's the problem, is like the dark pool is being abused to suppress buys, and it's being abused to accentuate sells. So it's like, you see Fidelity today, it's like 70 or 80% buys and 20% sells. And it's like, oh, well, that, it's like, oh, well, the sells must be much bigger than the buys. And not necessarily the case. It's just that the buys are going to dark pools and the sells are not. And so as a result, you get price suppression. And you can see it is like, why is ape dropped from like $8 to 350 or whatever in the span of less than a month? It's like no one's selling ape. Like, you can look at the volume. There's very little, like the first day of volume was 110 million, which is abnormally weird. And there's a lot of things weird that happened on the first day. But since then, the volume is steadily dropping in ape. And it's just, but the price keeps dropping because it's like 80% dark pool. So that's exactly what it's being abused. A lot of the trades that go to the dark pool shouldn't be going to the dark pool. And a lot of that's being facilitated because the market maker has discretion as to where to send those trades.
Wow.
That's the order flow. So that's why Citadel, it's not so much that Citadel makes money off the order flow. They do, but it's more the case they can control the timing of when those trades go to the lit exchange.
I'm getting more and more pissed as you talk. I will be honest with you, Peter. I'm like,
wait, hold on. So let's get it more upset, Peter. What about the failure to deliver? Like they said, I'm saying they like in the millions, and I heard somebody say I think that's where all the synthetics are hitting. What do you think about that?
Yeah, so like the failure to deliver typically arises when someone sells a call option, someone exercises it, and the owner, the seller of the call option says, I need more time to locate those shares because I wasn't sure if that was going to get exercised. So it's like, okay, you have typically when you sell a share, there's a 3-day settlement, and you got to go like, I already sold that share. I got to go find it again. You got to go scramble and find it. But then if you don't find it, it's a failure to deliver. And with options, though, I think there's a T plus 35 window. So you have 35 days to go find that. So they've basically been doing this is they've been, selling AMC call options like crazy, like Mudrick did, and they've been like allowing them to be exercised if they get exercised. Like I said, usually it's like if they don't get exercised as a free premium for the seller. If they do get exercised, like, oh, I got to go locate those shares. And you would think in a normal market, hey, AMC closed at 10 today. That means that all these call options that are in the money are get exercised. That means there's a huge amount of AMC buying interest that should occur next week because it's T+2, whatever. And what happens on the Tuesday is nothing happens. It's like, well, there should have been a huge amount of buying interest. Well, they just went to fail to deliver. Okay, well, now they're failed to deliver. When are they going to get bought? Oh, they have T plus 35 days. It's like, why on earth do they have so much time? But so you get these failed to delivers, and then everyone gets excited. Oh, the SEC is going to publish the failed delivers for this month. And I think in August or something, there was a day where there were 10 million AMC failed delivers. It's like, really? 10 million shares? Like, and typically it's less than 50,000. So we did have like a day, a few weeks later where there was a big AMC run up. But more or less, these failed delivers get hidden because then instead of actually on the T plus 35 purchasing the shares, they do some sort of swap with someone. And it's like, okay, we're going to, give me an extra 90 days to fill this. I'm going to do a swap, and it's an off balance sheet. It's an over the counter swap between two counterparties. No one else knows about it. And all of a sudden, this magic pressure to buy the MC shares disappears for another 90 days. Or 180 days or 365 days, depending on the term of the swap. So that's how it basically an option position gets created in the option market and then gets swapped to eternity. And so why this phase 6 that people are talking about that happened in September is like for before, if you're doing these off the counter swaps, no one knew about the details. I mean, now phase 6, it becomes like there's a third party evaluating the risk, and is there enough credit assigned to these swaps? So all these swaps that have been done to hide these failed to delivers are now going to be monitored by someone eventually when they come. Like, they have to be reported, and it may not be that they don't get reported till about the time they're due. Hopefully it comes before that, but I'm sure they're finding ways of delaying paperwork. So a lot of this stuff that's been hidden, hopefully phase 6 will eventually come to light. And so we're hoping that like this will be one of the things that causes AMC to square is they can't keep hiding this stuff through swaps. The swaps, they can keep doing the swaps, but then they have to account for the margin on which they probably haven't been doing. So it's like, okay, you've got these huge positions, you need to start covering them. So that's another issue, but that's the whole failed delivers is being abused. And you got ape, the first day of ape, there were 43 million failed delivers. It just, I feel sick to my stomach even talking about it.
Oh my God.
So like this is, like I said, 10 million for AMC was dramatically huge. So 43 million ape, it's like, you tell me that there were no irregularities with AMC, that because like every AMC shareholder should have got an ape. There should have been a clear one for one, no one should have had an ape coming late. No, everyone should have got their ape on time. Yet there were delays all over the place. Some European brokers won't even allow you to buy it. And then there were 43 million failed delivers on the first day. With the first week of trading, ape went on the threshold list because there were too many failed delivers. So it's clear there's an issue with ape. And all of a sudden, all the YouTubers say, oh, you should sell ape, like before the fail to deliver knowledge came out. It's like, yeah, you should sell ape. You should buy anything but ape. It's like, and all these YouTubers saying ape is the crap, and Adam Aaron's screwing you with ape. It's like, no, there's a reason why they want you to sell ape, because they don't have it and they need it. And that's why there are 43 million failed delivers on the second day or the first day. So it's a big problem. They have failed. The failed delivers are basically hiding the extent of the problem, but the failed delivers are clear evidence that naked synthetic shorting has happened. And that's the biggest point. Is like the corruption is visible. You can no longer gaslight us saying, oh, you guys are imagining it, or no, these all get taken care of. The DTC wouldn't allow it. Oh, the DTC has allowed it, and they failed miserably in policing it. So
what I'm curious then what does the community's options? Like, so like, I'm a social media guy, like I told you, Peter, obviously.
Yeah, the sad thing is, again, we're left with two choices. You eventually, as I said, with phase 6 transparency, it comes to light that like these positions are massive, and it's like anyone in a risk management department would be freaking out, and journalists will basically pick up on this eventually. Whether the mainstream MSN probably won't, but like there's like Parade on Wall Street Parade and other sites, they'll basically catch this, and eventually there's enough people in AMC that are talking about it, like through LinkedIn and through other places, that it becomes more aware that like this is a huge corruption problem. So that's one thing. So yeah, buy and hold for one thing. And yeah, we're counting on it being such a colossal mess that the DTCC, the SEC, and the DOJ have to basically take action, because otherwise it's like you guys are looking like you're complicit. And it already looks like they're complicit. The DTC with the GameStop share dividend split misallocation already looks complicit. And obviously with ape, they look bad as well. So there's already pressure building. And again, there's a DOJ investigation. So I think the main thing is, yeah, we have to buy and hold, but like we have to be making sure that all these issues do get more broadcast. And that's like a question of how do you do that effectively? Because mainstream media is not going to do your job for you. And that's the thing. They're not out for us. There's allegations. Again, like Ken Griffin has connections to Fox News. Ken Griffin has connections to MarketWatch. Ken Griffin has friends at CNBC. So it's a very difficult process to get the word out to the right channels.
Yeah, MarketWatch, all those publications are all in cahoots, right? And that's the crazy part. Like, so when you, like you said, like, so buy and hold, and obviously bring more awareness to the situation, right? Because it feels like we have so many smoking guns around the place, but just nothing can get done about it. So for anybody listening, I talk and preach the shit all day, guys. Branding, getting yourself out there, creating community. Do you see what the Reddit and ape community has done? We can literally flip the market on its head if the right people start asking the right questions and looking at the right information. So like this can be really, really big, guys. Like, so do your own research. Don't just take it from us. But what do you tell somebody right now, right? We only have a couple minutes left. What do you tell somebody? I know you're saying buy and hold, but if we're already getting effed over, why would
that's the problem. It's like everyone has to take in account what their financial position is, how much can they risk. And a lot of people like jumped into AMC because it was following last year, and they did it on margin, or they took out a credit card loan. And then it's like, man, it's like, I really love the story, but I can't do this anymore. And that's going to be like the other part of the problem is I sell the next day AMC rips. And it's like, how do you live with that? And that's the problem. And that's what I've been in. It's like, I can't sell this now. The hedge funds have created a situation where I saw what GameStop did. I know what's possible. I know what they've been doing. Everyone knows what they've been doing. We can't sell now, because if we sell, unless we need it to go pay the mortgage or the rent or baby's diapers or whatever, we're going to hold our stocks, because it's the psychological damage of selling and then seeing it rip would cause more harm than anything else. Like I've been sitting here watching my AMC stock. I've been holding for 18 months, and I'm saying I could have made so much money doing other stuff, but what would have happened if they had ripped? And I would be, I made $20 on this play, but I could have made 200,000 on this play. That's the problem. So we don't know. There's no guarantee AMC will rip. We don't know if it does rip how high it will go. It will depend on so many different factors. But the fact of the matter is that the conditions are, if there's ever been a squeeze, this is one of the plays that will never be replicated again because they'll have to change the rules of the market dramatically to prevent it. It's like that's the ultimate problem. So yeah. But like for guys that are like, if you have money and you got to be careful, the option market is obviously manipulated. And I made a lot of mistakes playing AMC options last year. I lost about half of my gains just through option premium last year. So that's painful evidence. I continually to think that like it was going to rip, and I was deluded. They were manipulating the market so that it would fall to 35, and then they blew it up to 55 again. So you think, okay, and that's what they were doing that for. They kept enticing people to buy calls because they kept making those spikes happen. So the market price is clearly able to be manipulated by the market makers, and presumably that was to generate option premium. So that's a big thing. If you're going to play this, be very careful about which trades you play options in. There are some things like the SPY, which is too big to be manipulated. Go for your broken, play calls and puts as much as you want. But for something like AMC, it's too manipulated to play options. That's my personal opinion.
Love it, man. Love it, man. I wish I can geek out about this shit all day, man. And I'm gonna be honest with you too, Pete. For a finance guy, I mean, you got me on the edge of my fucking seat right now. I'm like, do I do it? Do I take it? Do I not? What do I do, man? But everything you said was spot on, and I really appreciate you taking time to educate the audience. Like one of our big goals, right? Especially for our community, we want to make sure that people are educated, that they know what to look out for, not to get screwed over. How can we use our voice to create change? And having conversations like this is one step towards that. So I appreciate you, man. You don't know us from a hole in a wall. You came in, you had a great conversation with us, and I just really appreciate you, man. And I would love to extend an invite any other time. So if something happens, man, I would love to be able to call you, Pete, and be like, man, we're ripping, baby. Are you coming through?
Absolutely. Yeah. Feel free to drop me a line on LinkedIn anytime, and we can, if something interesting comes up, let's have another one. So
please do, man.
Appreciate you, Peter.
Definitely.
Guys. My pleasure.
Yes, sir. So thank you guys. We have another great episode next week. So we're going to end off. Next week, we have the global social media manager, Eric Toda of Facebook and Meta. We're going to talk about Web 3.0, the metaverse, some ways to monetize in that space. So if you guys are into that, please join. But thank you guys both, man. It's Friday. Hope everybody has a great weekend. And we're going to do it agaagain. So we'll see you guys next week. Thanks for another great episode of More Than a Title. We'll see you soon.